So we're starting with, like Joanna said, there's almost 600 pages of rulemaking here, and we are going to try and gallop through all of that stuff in the next 20 minutes. So just by its nature, there's going to be a few things that maybe you have some questions. I'm really happy to answer questions. And also, of course, email me if you have any questions, or email Early Shares and they'll put you in touch. So here's some things about the basis of the rulemaking. And we're seeing this, and this is a point I need to make with respect to the SEC's rulemaking. The stuff that's on the slide here, this is stuff that was in the Jobs Act. When we look at the comments that are on the SEC's comment page right now, approximately half of them are criticizing the SEC for imposing rules that were imposed on the SEC by Congress. So anyone who has a problem with a $1 million a year limit should go to Congress. Anyone who has a problem with the fact that limits are imposed on the amounts that investors can invest should go to Congress. Anyone who has a problem with the creation of crowdfunding portals and their regulation by the SEC and FINRA, you know the answer, go to Congress. So these are the four essential conditions that are set out in the statute, and then we get into a lot more detail. So these things cannot be changed. Right. So the next, this is where we are right now with respect to online offerings. What can happen right now, and what we are working with Early Shares on, is Rule 506 offerings. Those are offerings that are made to only accredited investors, that is folks who have at least $200,000 a year or $300,000 with their spouse, or a $1 million net worth not including their house. These offerings can be made on a generally solicited basis, that is advertising, skywriting, on the internet, on TV, however you like. The condition, if you do general solicitation, is, though, if you do a general solicitation, you must take reasonable steps to make sure that your investors are accredited, and that's a bit of a burden right now. The other alternative is that those offerings can be made on a quiet basis, usually hidden behind accreditation firewalls that you can only get past them with passwords. And there's a few online offerings happening that way. They can take various types. You can have direct investments, or you can go through VC funds where all of the investors are collected together and they make one investment through a special purpose vehicle. That's the stuff you can do. The stuff you can't do yet is the offerings to everybody under regulation crowdfunding, and I'm just going to call it Regulation CS because that's much easier. So what are the conditions of Regulation CS? The $1 million limit. This is not as bad as it sounds. A lot of people have said, hey, you know, we're a life sciences company. We can't do anything with just $1 million. But the thing that the SEC has done in its rules, which was not a foregone conclusion, so we're really, really pleased that they did this, is that they've said you can do other offerings side by side with the crowdfunding raise. So you could do a 506 offering to accredited investors, and at the same time you could offer the same securities to your family and friends and neighbors and staff and customers. And so that is a great thing. I think we're going to be seeing quite a few of these. The one thing I would say about side-by-side offerings, though, is don't do it without a really good securities lawyer, because there are different conditions that apply to different types of offering, and you want to make sure you meet all of the conditions of each type of offering that you're doing. So that's a $1 million limit. Investor limits. Again, you know, this is a statutory requirement. If the income or net worth of the investor is below $100,000, the investor can only invest 5% of his or her income or net worth a year. If his or her income or net worth is above $100,000, then that person can invest 10% a year. There's a floor of $2,000. Even if you don't have any money at all, you can still invest $2,000 of your non-existent money. And if you are super wealthy, you're still capped at $100,000 a year. In calculating what your net worth is, you have to exclude your primary residence. And the SEC's interpreted these rules to say if you fall within both of these categories, because of course you could have income below $100,000 and a net worth above $100,000, you can choose the higher limit. You can include your spouse's income in determining income. And the great thing from the point of view of all of the portals is that these limitations are essentially self-certifying. That is, what your limit is and whether you have exceeded that limit or not are going to be on the investor. So early shares will ask or provide some guidance as to are you okay with your limits, and they will be able to rely on the person saying, yes, I have a net income of $100,000, therefore I'm allowed to invest this amount. That's going to be useful. You have to use an intermediary. This means everything is going online. You won't be able to have like an old-fashioned stock exchange in your local coffee shop. An intermediary is anyone who puts buyers and sellers of securities together on a platform. These people are going to have to be registered with the SEC, either as a broker-dealer, which is something like Merrill Lynch, or it will be a new crowdfunding portal, which will be a regulated entity, but it will be regulated not quite so heavily as a full-fledged broker-dealer. These are different from the rules that relate to online 506 offerings, the ones we talked about earlier, the accredited investor offering, because in those, you can put the information anywhere. But what the SEC is trying to do here is make sure that all of the information, whatever the issuer puts together and whatever the crowd says about that offering, everything's got to be in one place so that all of the investors are treated equally. They don't have to go to two separate platforms to see what two sets of commentators are saying about the offering. And so as a result of that, you're not going to be able to use multiple platforms. It's all going to be in one place, and it's got to be a broker-dealer or a portal. The disclosure. Now, here is an interesting thing about the disclosure. Most of this was actually mandated by the statute, and it's the sort of thing that people would want to know before they make an investment. And there's been some criticism of this being too much and too burdensome and too complex. Really, this is the stuff that any rational investor would really want to know. And as far as it being too complex, well, there's an answer to that. If an issuer lists on a platform like Early Shares, and that platform uses a company like CrowdCheck, that team together will get the entrepreneur through it. That team together will help the entrepreneur make sure that they have met all of the requirements of the SEC. This is not something that good intermediaries are not going to leave entrepreneurs to themselves. They are going to help and make sure that those things are properly disclosed. So you can see information about your incorporation, information about your officers and directors, your business and future plans. That does not mean you do not have to have a business plan. One of those 50-page things that says everything about what you're going to do. What they're talking about is just a written description of what it is you are planning to do. You've got to include risk factors. That is the things that people would especially want to focus on. You've got to talk about what you're going to do with the money, and there has to be disclosure about how the offering process works and how you have priced the securities and your capital structure. And like I said, all of this, you can get help with that from a good intermediary or somebody who uses CrowdCheck. So going on to financial disclosure, you have to disclose your financial condition. You have to talk about previous capital raising. Who have you sold securities to? You have to talk about indebtedness. And you have to produce financial statements. This is, again, one of the things that was criticized both in the SEC's rules, but it was in the statute. So under $100,000, the financial statements just have to be certified by a company officer, and you have to produce your tax returns. Between $100,000 and $500,000, those financial statements need to be reviewed by a CPA. And when I say if it's under, I'm talking about the offering. If the amount of securities that you have sought, that you're looking for, fits within these categories. So if you're over $500,000, you have to get your financial statements audited. Now, there has been a lot of criticism about this, too. People are saying this is going to be ridiculous. You can't spend $40,000 getting audited. We're talking to a lot of reputable auditors who are willing to audit small companies for a much smaller amount, more in the sort of $4,000 range, and I'm sure that price is going to come down as competition develops. So don't get too worried about this. Just know that you have to do it. And the one disappointment I think that people have had in this area is the SEC has said, even if you are newly formed, even if you were formed like last week, you're going to have to get your financial statements audited if you're looking for more than $500,000. They say, and they're probably right, that the costs scale. So a very small company, a company that hasn't been around for very long, won't have very big fees. We'll see how that develops. So what do you do with this offering information? You have to file it with the SEC on Form C. There is no format dictated for most of the information. And this means you can be really quite flexible. What we're seeing in online offerings at the moment, people use videos, people use slide decks, people can have clips from reviews of their product, for example. You can use all of that stuff. It all has to appear in one place, which is the funding portal. And the real rule about this is if there's a misleading statement in there, the issuer is liable for it. So you have to make sure it's true, and you have to make sure that it's complete. You can't tell a half-truth. If you've had some great reviews of your product and some terrible reviews, you can't just pick and choose. This information is not reviewed by the SEC. They're not going to give comments on it, but you can probably assume that the SEC will keep an eye on it and give you a call if they see anything terrible. Ongoing filing requirements, pretty much the same information has to be filed with the SEC every year with the same level of financial review. We think that's a little bit harsh, and that obligation will continue until all of the crowdfunding securities have been acquired by somebody else or the company. Just a word on the ongoing filing requirements. CrowdCheck can do that too, so don't worry about this too much. You've got friends. Going on to the next one, which is, so how do you make sure that people know that you're doing your offering? It's very limited. You're not going to be able to do any advertising except notices that say, this is who we are. We are a small company that sells cupcakes in Illinois. We are raising funds. We are selling preferred shares, Class A, which will have an interest rate of 8%. And please go to early shares to see details. That's all you're going to be able to say. But you will be able to say it on Facebook. You will be able to say it on Twitter. If you're rich, you can take out advertisements. But all you can say is just, we're doing this. Go to early shares. This is where you will find all of the information. And again, this is the same reason as I discussed before. The purpose of this is to make sure all of the information is in one place. Okay, so next one. Bad actor checks. This is something everybody's going to have to do. This is now absolutely compulsory. It's part of the fraud prevention and protection. If you have so-called bad actors, and suddenly, as a woman, this used to be called the bad boy provision. But the SEC is now, with the times, we know that everybody can be bad. So bad actors. It's not just Tom Cruise. And these rules cover officers, all their officers, directors, 20% shareholders, and promoters. That is people who are being paid to try and get people to invest in your company. All of these people have to be checked out to see whether they are bad actors. The bad acts include 8 different categories of financial fraud and regulatory violations. So if somebody has lost their broker-dealer license, or if somebody has been guilty of embezzlement within the last 5 to 10 years, it's different for different categories, then that person can't be involved. He's not going to be able to be an officer or director or a shareholder of your company. Otherwise, you can't do an offering under Regulation CS. The person who has to make sure that this works is the intermediary. This is early shares. So early shares will be running background checks, and we will be doing that for them. Going on to the next one. If the conditions of Regulation CF aren't met, now there is, I've outlined some fairly burdensome stuff, right? There's a lot of rules you have to comply with. But if you innocently just miss something, you thought that you'd put in the information about your 20% shareholders, you just forgot, you misread the rules. If it's an innocent and non-material violation, you're not going to be in trouble. But if the violation of the rule is significant, so for example, you didn't add your financial statements when you filed with the SEC, then the problem is that you've now violated the requirements of the registration provisions of the Securities Act. And these are the provisions that say if you're making an offer to the public, you've got to register with the SEC. Regulation CF is an exemption from those rules. So you've just now violated the SEC's rules, and the remedy for that is rescission. That means you, the issuer, have to buy the shares back. And that right extends pretty much permanently. So the trite thing to say here would be just don't violate. Make sure that you're using good intermediaries and good service providers. What happens to the shares? For a year, they cannot be resold. They can only be resold to the issuer, to an accredited investor, in an offering that's registered with the SEC, like an initial public offering, or to a family member. Even after that year, though, you're not going to be able to trade them very easily because you have to register or have an exemption from the state securities laws as well. People do tend to forget that. So it's going to be very difficult to sell these things. Going to the next one. And I mentioned this before, and this is really important. There is liability for misleading statements. An untrue statement of a material fact or an omission of a material fact means that the issuer has to buy the securities back and pay interest, and there may be other fines and possibly even criminal actions brought against them. The officers and directors of the company are all liable for a misstatement of a material fact, and they have the burden of proof. They will be liable for saying something that's not true, an important thing that is a material thing. They're liable for saying the thing that is not true unless they can show that by the exercise of reasonable care, they couldn't have known that it wasn't true. And this is where due diligence comes in. This is where the services of a company like CrowdCheck protects the entrepreneur and the company from itself. Because going through our process, what we would say is the exercise of reasonable care. There are some other forms of liability, but this is the one that specifically relates to crowdfunding. So I am pretty sure that everybody is just looking at the screen going, oh my God, I don't know. So I'd be very happy to answer some questions.
Great. Thank you so much, Sarah. That was an excellent overview for us. We really appreciate it. And I think when I really think about what was just proposed by the SEC and in the context of the industry overall, I think that we are encouraged that in every place where the SEC had a chance to reduce the friction in the process, it seems like they took that opportunity. And as Sarah mentioned in the beginning, many of these requirements were actually put in the statute, which really doesn't enable a lot of flexibility in how the proposed rules were put forth. The other really important message here is that companies like Early Shares, intermediaries like Early Shares, and we're affiliated with a broker-dealer as well, and working with CrowdCheck, we help with that process from both the investor perspective and also from the issuer perspective. And so while we always encourage everyone to seek their own legal counsel as they go through this process, as a platform, we're really providing the guardrails to enable people to pursue these, hopefully soon, Title III and Title II offers in a way that there is some comfort and security along with that process that takes some of the guesswork out of how do you make an issue like this, how do you offer securities like this, and how do you become an investor in securities like this. And with that, I'm going to push back to Solomon, who has some questions from the audience, and we're happy to answer any of those.
Thanks, Joanna. So we received a few interesting questions, some industry specific and some a little bit more general. So let's start with some of the general ones here, excuse me. Were there any big surprises in the rules, Sarah?
Not to me, and I say that just to give some context. I'm basically a Wall Street lawyer by background before I lost my mind and came into the crowdfunding industry. If you're brought up in the super regulated area, you're kind of inclined to assume that things will stay pretty regulated. I characterize the way that the SEC has chosen to regulate portals as of the choice of Kickstarter Plus and Merrill Lynch Minus. They took the Merrill Lynch Minus. But as Joanna said, they didn't do things, there were some things that they could have imposed that they didn't. I mean, there is both they and FINRA, the guys who oversee securities intermediaries, are permitting portals to take commissions. They are not requiring portal personnel to take examinations. They're not requiring the posting of capital. There's just a smaller bond. So really, I do not think there were very many surprises in those rules.
Okay. And what is your best guess on timing of implementation?
Oh, well, it's always a guess, and I've been absolutely wrong for the last 18 months, so don't listen to anything I say. But here are some things we do know. We do know that the comment period will be open for 90 days. We do know that at the other end of the process, when the rules are adopted, there will be a 60-day period before they can be effective, because that's in the Administrative Procedures Act. And there's also a small business component to that. So there's a minimum of 5 months. And then the unknown quantity here is how long will it take for the SEC staff to take a look at the comments, work out what they're going to change, work out what they're going to keep, and then present the final version. That's got to take at least 2 to 3 months. So we are, we have to be at least 8 months away, and it may be more.
What do you find to be the biggest risk for issuers?
The biggest risk for issuers is going to be something that we see all the time on the donation reward crowdfunding sites, which is being too optimistic and making statements that they don't have a basis to make. So if you're going to say something like, I anticipate or I'm confident that I can ship product by December, and you really don't think that you can, if you know that you haven't signed up the contract with a supplier or a manufacturer, then you're going to be liable for that statement. People don't think of that sort of statement as being fraud, but in the securities law land it can be. So be very, very careful about overreaching and overly optimistic statements. I mean, the way to temper that is, if everything works out and I get a supplier in line shortly, I confidently anticipate shipping product by December. But always show your work. Always show what are your assumptions, and always tell people, look, this is forward-looking. I have no, it might not happen that way. So making misstatements without really meaning to be bad, but just being overly optimistic. Always say what your assumptions are.
Okay, we're going to take 2 more, and then the rest will be posted online here. With the resale market being restricted, would you say that exit strategy will be a key component of offerings?
I think it will be, and I think there will be 2 different sorts of offerings that are done as crowdfunding. There will be some things that really are never going, where there isn't an exit and you don't care about it being an exit. So, for example, your neighborhood coffee shop that you want to support because it has great poetry readings at night and stuff like that, they want to sell shares to expand. You know there's never going to be an IPO. You know that Twitter's never going to buy them. That you care about them, that's your passion. You want to invest, you don't care about the exit. And then there'll be the sort of companies, the small startup companies, maybe the tech companies, where you do care. And then, yeah, knowing what the exit strategy is going to be important. And you know, when we go through the crowd check process, that's always something we ask. The answer is usually, gosh, I don't know. But if the company does have a strategy, it's something it's very important to find out what it might be.
Okay, and the last one here related to social media. Is Facebook okay for advertisement or solicitation? And if you could specify how to solicit via social media, or if there's any information.
Yes, it's going to have to be very dull social media, I'm afraid. You can say just, we are planning a capital raising. Please go to early shares. We are selling convertible bonds, and that will be pretty much it. You can identify the company so people know exactly who's saying it. But it really is, it's very limited. You can use any media you like, but what you can say on that media is super restricted.
Great.
Great. Thank you so much, Sarah. We really appreciate everyone joining us today. We remain extremely optimistic about this market from a Title II and Title III perspective, even though we are going to maybe have to wait 8 months, as Sarah suggests, which I happen to agree with that assessment as well. For early shares, for those of you who are interested in our platform, we encourage you to go online and register and go through the self-accreditation process for Title II offers. We are anxiously awaiting the launch of our first several deals. They are coming very soon. We are, as you can imagine, being very thoughtful and careful about how we launch our business in this new regulation environment, and we are very close to launch. So we look forward to working with all of you as you become either issuers or investors on our platform and enjoy this new market that we have. So thank you very much. And Sarah, I really appreciate your time today. And as Solomon mentioned earlier, this will be available recorded online shortly. And any questions that were not answered here will be also answered in our online as well. Thanks so much, everybody.
Thank you.